Welcome to today's episode of the Michael Yardney podcast, where we're going to be discussing the importance of understanding how property cycles operate to help you make more informed investment decisions. I believe as an investor it's really crucial to understand the dynamics of property cycles and how they can have a significant impact on property prices, rental yields and overall investment returns. Some people talk about an 18-year cycle, some about a 7-year cycle. I'm going to tell you what my 50 years of investing experience has shown happens to cycles as I chat with Brett Warren, National Director of Metropole Properties. So at the end of today's show, I hope you're going to have an understanding of the factors that drive property cycles, and that'll enable you to identify opportunities. So whether you're a seasoned investor, and I'm going to just remind you of some things you know and give you some distinctions, or if you're just starting out, as I said, I believe understanding how cycles work is crucial. So let's get on with discussing this important topic.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
What's ahead for our property markets? Are they really moving to the next phase of the property cycle? Look, following that once-in-a-generation property boom of 2020-21, driven by falling interest rates at a time of strong demand, our property markets fell into a slump in 2022 as interest rates rose. However, it seems our housing markets are now finding a floor. Asking prices have been increasing around the country since the end of last year. The rate of decline and fall in many locations has decreased, and in other locations, median prices are increasing. In other words, the property market's doing what it's always done. It's working its way through the market cycle, driven by various factors such as interest rates, consumer confidence, supply and demand, economic conditions, government policies. And by understanding these cycles better and their different phases, investors can make better informed investment decisions. So that's what I want to discuss in today's podcast with Brett Warren, National Director of Metropole Properties. Hi, Brett.
Hi, Michael. Good to be with you. And it is an interesting time. And I'm looking forward to this podcast because we did touch on a few of these things during the week. And there's certainly things, you've been a student of this a lot longer than I have, that I kind of picked up on. So I'm looking forward to discussing this today.
Well, some commentators refer to the 7-year property cycles, and there's others talking about an 18-year economic cycle. I guess what they're trying to do is explain how, whether it's the economy or house prices, move through different phases. And in fact, the cycle length varies. I don't think there's actually an 18-year property cycle or even necessarily a 7-year one. The cycles vary in length dependent upon a whole range of socioeconomic factors, not because of a period of time. And to say that there's an 18-year cycle, as some are out at the moment saying, Brett, because it's done that for 800 years or hundreds of years, that doesn't really work in today's more digital economy and market. But Brett, I think it's worth just walking through the 4 distinct phases of the property cycle, and let's not necessarily put a time frame around them so that people can understand what's going on and where we're at and what's ahead.
Yeah, I think that's a good point. And look, obviously, if you're researching, you're looking at these types of things, the 4 distinct phases are the boom, which is probably what we've kind of just been through, the downturn, the stabilization, and the upturn. So maybe we start at the top, Michael, and explain a little bit more about the boom phase.
Well, the boom's one everyone likes, isn't it? That's where people see property values increase a lot. But interestingly, the boom at the end of the cycle, if you see it as a circle, tends to be the shortest phase. There's strong demand from investors, strong demand from homeowners, and this creates a rapid increase in property values. And several factors lead to this. It's often related to low interest rates, to a strong economy, to population growth, to favourable government policies. And these booms generally attract a whole new generation of investors into the market. And at the same time, would-be homeowners as well push up demand. There's FOMO. And typically, the characteristics of a boom include a rapid rise in property values, often exceeding 20%. And hey, you're right, we experienced that recently. It's usually associated with low unemployment and strong wages growth, strong consumer confidence, optimism, and that experience of FOMO, which is driven by greed and fear. And usually during the booms, there's lots of increased construction activity. They've started before the boom, so we see all those high-rise towers. Didn't happen much this time round, but look back at previous booms and we always see that there are all these new developments, because it's not only home buyers and investors that are excited, it's also developers wanting to take advantage of it, Brett.
Yeah, look, it's a highly emotional time, isn't it? And we've got that fear of missing out that certainly drove the markets recently as well. But it's interesting to say that it is the shortest phase, I think, in most of the cases, which is why you've got to understand property is a longer-term game. As they say, Michael, all good things must come to an end. And I guess we get to the downturn phase now. And I guess that's kind of where we're moving through now.
You're right. So each boom leads to the downturn, and people get disappointed when that happens. But we also have to understand that the slump phase is the precursor to the next stage of the cycle. Now, people will say, well, why don't property values just keep going up nice and steady and consistently? Wouldn't that be nice, Brett?
It certainly would. It certainly would be much easier to predict.
But it's related to human emotion, fear and greed. So during the boom, the markets overshoot because of FOMO and fear and people wanting to get in. And then during the downturn, it's a different fear, a fear of buying early, a fear of buying a property that's going down in value, a fear of making a mistake. So the downturn or slump phase is usually characterized by an oversupply of property because there was that excessive construction at the beginning of the boom period. And all of a sudden, there's just too much supply. There's not as much demand. Demand cools. There's usually high vacancy rates. Rentals decrease. And in some cases, property values drop around 10% or so. That's what's happened in the past. Interestingly, the recent slump of 22-23 was not brought on by an oversupply of properties. That makes this particular downturn that we're finishing up on as we're talking now, it's coming to an end. That's made it very different to all the others I've invested in, Brett. It was really initiated by a lack of affordability and then exacerbated by rising inflation, rising interest rates, lack of consumer confidence, and the media scaring investors. It was an affordability issue this time. We have had very low vacancy rates, minimal oversupply of properties. So it's a different downturn this time.
Yeah, a lot of people aren't highlighting that, are they? I think that's one of the interesting things we discussed the other day was about it's not coming to an end because of an oversupply or anything like that. It's other factors. And I guess the other thing, Michael, would it be fair to say that at this time around, and I don't know in other phases, Michael, but do the boom phase and the downturn phase kind of last about the same period? Are we seeing that now?
Well, you're right. I think if there's a bigger boom and prices have overshot more than they should have, then the downturn takes longer to correct because there's the long-term trends and they go back probably only about 45 years, the latest the statistics from the Australian Bureau of Statistics showing that on average, over the long term, Melbourne's performed just over 8% per annum capital growth, Sydney and Brisbane just under that. In other words, it's actually been doubling in values around every 10 years or so on average. But there's lots of years when there's no growth, other years when there is growth. That's what understanding the cycle's about. So they tend to revert to the mean. They tend to revert to those average long-term trends, Brett. So you're right, if it overshoots a lot, it'll undershoot for longer as well. And typically the downturn stage is characterized by falling property values, rising unemployment, slow wages growth. We actually haven't had the unemployment and slow wages growth this time round. It's a very different downturn, and that's why I think it's going to be shorter. They all are related to reduced consumer confidence, to pessimism. It's the media driving that. And usually at this stage of the cycle, there's decreased construction activity in property development because it starts off with a large oversupply. This time round, there isn't much construction activity or new large property development for different reasons. It's the fact that they're not financially feasible. Building costs have gone up so much. There's a lack of labour and materials. So new development is not financially viable, especially the big towers. So that's another thing that's going to currently underpin property values. We need all those large new developments to support the immigration growth. The problem is developers aren't going to do it if it doesn't stack up. And so this eventually leads to the next phase of the cycle that we call the stabilization phase. So the downturn doesn't just go into a boom again or an upturn again. What it does is come to the point where eventually interest rates stop rising, pent-up demand has accumulated because people have sat on the sidelines for a while, buyers come back into the market. And even though you and I, Brett, think about it as investors, most buyers are sellers and sellers are buyers. So buyers and sellers come into the market because they're homeowners. 70% of transactions are usually related to home ownership. And this next phase of the cycle that I believe we're going to see for much of the second half of 2023 will be what I call the stabilization phase, where buyers come back, sellers come back, and slow property price growth occurs. And this time around, it'll be again driven by demand, more demand than there is supply, good, strong employment, wages growth occurring, and in due course, improving consumer confidence and optimism. I know you've often said, Brett, that the market's going to reset this year.
Well, I think everyone agrees that it will reset at some stage this year, and we can probably get into picking exactly when. No one ever knows. We'll get into that later, I guess. But I think obviously we're in that phase now where we will start to restabilise. I think as an investor, it's really important to understand this phase, Michael, because especially when you understand what drives the market, most people, when they get to this phase, they've kind of maxed out their borrowing capacity, their savings, all those kinds of things. So we've got to look for areas where incomes and wages and things are growing faster, where people can actually recharge. The faster they're able to recharge, the faster they're able to start buying again and spending money again and things like that as well. So that's one thing we focus a lot on. And I think that's really where we're heading at the moment, is getting back to the basics and understanding those fundamentals.
Look, that's really important because there was a whole generation of new investors who came into the market over the last 3, 4, 5 years, and they saw property values increase everywhere. Good properties, bad properties, regional locations, main road, as well as other locations. And that, to them, is the only way they've understood what's happening. But I see, as you're pointing out, a much more fragmented market moving forward related to affordability, Brett.
Yeah, look, it's something that we obviously hinge a lot of our research and data on, and it proves consistent as you go. Once we get through that stabilization phase, and that can probably last a little while now as things start to recharge and the economy starts to get going again, we start to head back into that upturn phase.
That's right. Now, these phases take time and often in the past have lasted a couple of years. This downturn phase really was probably just over a year. The Sydney property market started to turn down in February 2022, Melbourne a few months later, Brisbane only in the middle of 2022. Each state is running its own cycle based on local factors. So even though we've got all the same interest rates and the same governments and the same tax regime, it's a lot to do with local economy, local factors driving it. And it's not jumping straight from the stabilization phase to a boom. The boom, as we said right at the beginning, is the shortest phase, but there's the upturn where vacancy rates decline, rents increase, property values rise. And this phase in the past has usually lasted 3 or 4 years. It's been shorter the last couple of times around, but in the times I've been investing over 5 decades now, the upturn phase is a great phase. It takes time. Builders and developers get confident. They start new projects. They want to complete them over the upturn phase of the cycle. And the economy goes well. Employment grows, wages grow, consumer confidence and optimism occurs. And it finally kicks off into the boom right at the end, the short phase. But the upturn phase and the boom phase is the phase people like. Having said that, as we're entering the stabilization phase of this current property cycle, it's going to take a while for the media to understand what's going on. And that's why we're getting mixed messages. And those with a short-term focus are really not going to get into the market until they read that property values are increasing and hearing about all those great auction results and seeing other people have had success. But I know at Metropole, we're actually seeing a lot of, I guess, strategic investors, people who understand this, taking advantage of the current phase, getting their ducks in a row, getting set and taking advantage of this, because they realise by the time they read about it in the media, they've missed the bottom.
Yeah, and it's very, very hard to judge that, I guess. Look, I think the other interesting thing is, Michael, look, you can probably answer this question, but I think it's been the first time in a long time that I can remember that all property markets were actually in sync with each other over the last 3 or 4 years in that boom cycle.
Very unusual. Very
unusual. But I think we're getting back to that fragmented market as well now. So you can already see Sydney and Melbourne starting to pick up a little bit. Brisbane's probably a little bit behind. So you talked a little bit about local markets and market factors. What are some of the influential kind of factors on those property cycles and lengths that we're going to start to see now?
Well, again, I know people talk about the 18-year and the 7-year cycle. I don't think it's related to a fixed time period. But looking back over the last decades or so that I've been investing, when I first started, there wasn't the media like this. There wasn't social media. Property values were only reported a year down the track when what was then called the Valuer General would tell you what last year's statistics were, but there was a property boom. I started investing in the 70s, and I do remember a property boom of 81. I remember a property boom in 87, and then there was a stock market crash. There was a recession we had to have in the early 90s after that, and another property boom around 94. 2003, and you were in the markets then already and understanding what's going on. 2010, 2017, and yeah, we had that property boom of 2022. So it's easy to see why some people feel the cycle lasts around 7 years. Some of those were 7-year cycles. This last one was a bit quicker, but digging deeper into this, it's clear that over those 40 years, well-located capital city properties did double in value every 10 years. In other words, they grew around 7% per annum on average, according to the REIA and the Australian Bureau of Statistics. But at some stages of the cycle, values increased, and other times they stayed flat. And you know yourself, in Brisbane, there was a long period of time where property values didn't go up much, did they?
No, there was. And like I said, it was these local factors we're probably about to get into now. So, obviously things like, GDP and growth and the state of the market. I know Brisbane wasn't creating a lot of jobs. There was a lot of oversupply. We talked about oversupply of apartments and construction and things like that as well. So that was some significant issues. And what other issues are influencing those cycles, Michael?
Well, before we get into that, I do remember, though, when we were speaking with our clients at Metropole in Brisbane during that time, and the statistics and the media said the median price in Brisbane hasn't gone up much. That's true, but there were some properties that outperformed, and there was the opportunity to manufacture capital growth. And I remember in the old office, you used to show up some photos and some case studies of properties that increased in value considerably. So there are opportunities there. One shouldn't just say, well, the median price isn't going up, I better not get into the market. But to answer your question about what other factors affect the length of the property cycle, yeah, we already said the overall state of Australia's economy, the GDP, inflation, employment or unemployment. In other words, have people got jobs? Do they feel comfortable? Have tenants got jobs and they are able to pay higher rents? And then there's also the government. They interfere. Remember, there were tax incentives, zoning regulations, infrastructure. Brett, maybe I'll ask you a question about that in a sec, because before we get onto that, there's also interest rate policies, population growth, and the demographics. But over the years, the government has been picking on property investors, haven't they?
Yeah, it's an interesting topic, and I think there's not enough balance, because we've obviously seen those government policies, also regulators, Michael, when we are forcing to pay principal and interest. There's those serviceability buffers, higher interest rates and things like that as well. We had that credit crunch probably towards 2017-18 to slow the market. Again, we've talked about Queensland land tax. We've had negative gearing changes proposed, changes to super, all those kinds of things. We also had market intervention. And, during COVID, it scares investors. And I think there's a really dire consequence of all those types of things. It's really a targeting of investors. And what we're seeing at the moment, Michael, is quite extraordinary. It's the housing crisis and the rental crisis, which is obviously playing out because of some of these policies and reforms that people have implemented.
Well, I think the governments who are looking for money see property investors as an ATM. They think, I'll increase land tax, I'll change this tax, that tax, get rid of negative gearing. But the governments have actually recognised the consequences at the polling booths when they try to change the big taxes. But you're right. That's what's created the rental crisis at the moment. So many investors are selling up. The latest statistics have been suggesting that somewhere between 25 and 30% of all properties currently for sale on the market were previously rental properties. And the majority of these, we know, end up in the hands of owner-occupiers, which means the pool of rental properties is decreasing. Others are putting their properties on Airbnb to get better rents at the moment. Investors are annoyed by the government's interfering, and it's short-sighted in my mind, but they are jumping ship, aren't they?
Yeah, certainly. And they're not exactly providing solutions for that either, not providing public housing for those people as well. It's a very, very small percentage. I think 2 or 3% of the rental pool are affordable housing and things like that as well. So if they're bashing investors, there's not enough supply of those apartments. Huge demands coming in from obviously, the borders reopening and things like that as well with population growth. So I think it's going to get a lot worse before it gets better, Michael, until the government kind of comes up with some kind of solution. But if they keep bashing investors, the supply is just going to dry up.
Well, the simplest solution is encourage investors, and investors would love to provide the accommodation the government can't. But only last night we were watching something on TV, and it was a terrible, sad story of an elderly lady who needed I don't normally watch current affair, but it was on in the background. Pam had just finished watching the news, and this poor elderly lady with 2 knee reconstruction operations months out because of the waiting list, and she couldn't get public housing, and she was in rental accommodation that just didn't suit her because it had steps. The government isn't providing accommodation, and I believe it's their duty because there will always be a large group of people that are disenfranchised. We pay our taxes, and I believe it's important to do that to be able to help that element of community. But there's also another large group of people who don't rent because they're poor. They rent just because of the stage of their life, whether it's just got married, they just got divorced, because they've had a baby, because they're moving house, because they're moving state. And so not all tenants are poor. It's just people choose to rent, or rent vest is another thing. They want to rent because they can't afford to live in those nice locations. And that's the accommodation. It's about a third of the population in Australia that rent and have for a long time and are likely to continue to, that the government isn't or shouldn't necessarily provide accommodation for. They should be doing it for the people who can't afford properties, people who need social housing, and let the property investors provide accommodation for that swag of the population, a large percentage of the population who choose to be investors. And I know they're the ones that we target, the demographic that we target at Metropole, areas where tenants can afford to and are prepared to pay more rent, because in the future, your future income as an investor is really going to be dependent upon your tenant's ability to pay rent.
Yeah, good point. And look, there's certainly an appetite from investors to do that, Michael, but it's a lot of posturing by government. And it's really disappointing. There's no balance to this argument because they are providing a vital service, but they're seen as greedy and all those kinds of things. And I guess to provide some balance, Michael, look, it is hard. It's tough. I mean, the average rental price has gone up about $300 a month, which is, difficult in these cost of living times. But if you balance that argument out, an investor with a $500,000 mortgage has actually gone up roughly about $800 a month, and that's quite substantial as well. So, we've got to provide some balance to that argument, and a lot of people are targeting investors, and investors are greedy, but they're providing a valuable service that no one is actually offering at the moment, and I think that's really often overlooked.
Well, in Australia, that's the case. In other countries, the governments do supply a much larger percentage of rental accommodation. But in Australia, the government's decided, hey, with public transport, we'll provide some. Private bus companies will provide others. With hospitals, we'll provide some. Private hospitals will provide others. And the same with rental accommodation. But now they're taking advantage of the investors who've made decisions based on previous financial suggestions by the government, and now or APRA or the Reserve Bank, and now they're pulling out the rug from under investors. If we just get back a little bit to the topic of the property cycles, but I think there was a great discussion to have. Currently, different stages of the cycle, as you said a moment ago, different states of Australia, different locations are in different stages of the cycle. But the media tends to generalise about the property market. But there are many sub-markets. Each state's at a different stage of the cycle, as you said. And within that, there's sub-markets based on geography, price points, property types, apartments, townhouses, villa units. For example, the top tier, the more expensive end of the market, will always perform differently to the new home buyer segment. At the moment, the top tier is starting to pick up again, while new homeowners are feeling the pinch. Inflation's making it harder for them. Their wages haven't gone up much, but their rents have, so it's harder for the first home buyers to save a deposit. The cost of new dwellings has gone up a lot, and the HIA is reporting that new home construction is about half of what it used to be. Now, of course, we've brought forward a lot of first home buyers. That's what happens every time there's a grant. So there's always a lull afterwards. And while each stage is at a different stage of its own cycle, as we said, that was different last time round. So people have got to recognise now each state's running its own race based on local economics and supply and demand. But the big overriding thing, Brett, is fear and greed. That doesn't go away. And as humans, we often just make irrational decisions, like some who are selling up at the moment. I think they're going to regret it a couple of years down the track.
Yeah, certainly. Look, we talk with clients all the time, and it's understandable, but getting back to maybe our previous discussion as well, and obviously, tenants' rights are increasing as well. There's uncertainty, and government aren't providing enough certainty for investors, and sometimes they just want to cash it in. They've made their money and they want to move on. But I think playing the longer term game and understanding there's going to be these kinds of difficulties is all part and parcel of being an investor, isn't it? And certainly at the moment, it's all about fear and greed, these cycles.
Very much so. But that's human nature, and it always has been, and that's why there is a psychology. Crowd psychology tends to influence people's home buying decisions, not just investors, but usually to the detriment. Most investors and most home buyers are most optimistic near the peak of the property cycle, when the media is full of strong messages, when in reality, Brett, that's the time they're meant to be, I guess they should be most cautious, and they're most pessimistic when all the doom and gloom's in the media, like now near the bottom of the cycle, when potentially most of the risk's gone, Brett.
Yeah, look, it's we've kind of been through that FOMO stage, the fear of missing out, obviously making rash decisions and things like that as well. But we're almost in the opposite now during the downturn. I think you call it the phobia stage, Michael, the fear of buying early, which is taking hold at the moment. No one wants to get in too early, and they want to time it just perfect. But as we're kind of talking about, it's very, very difficult to do that. By the time you get all the good news and all the good media, the market's moved to the next stage of the cycle, and you've missed that opportunity.
Well, as you said, we're getting a lot of inquiries from clients at Metropole. And as the national director, you're looking after the team of property strategists. And we always start off by putting a strategic plan together. So we're not talking about the property. We actually start off talking about where you are now, what you want to achieve. Is it realistic? Is it feasible? If that's the case, what you need to do? Because we know that 50% of investors sell up over the first 5 years, and the regular CoreLogic Pain and Gain report lets us know that many of them sell at a loss. We also know others just stay in the market at a loss as well, rather than owning the right properties. And we know that 92% never get past their second or third property, yet a audit of the results of our clients at Metropole have shown that our clients are 7.3 times more likely to get into that top 1% of investors who own 6 or more properties. And that's because they've made the right decisions by getting the right advice first. And then our buyer's agents are more than happy to help buy a property with their mixture of on-the-ground knowledge and the detailed research our research department puts together. And at this stage of the cycle, we're looking for properties with strong fundamentals for potential capital growth. And that has to do with the demographics of the area, as you said, areas where there's a larger percentage of owner-occupiers, areas where people's wages are going up more than average for the state, and areas where there's going to be gentrification improvement. And again, it depends upon people's budgets, where they can invest, but there's some great opportunities, particularly in the 3 big capital cities of Australia at the moment, Brett.
Couldn't agree more. And those fundamentals aren't going to change. There's going to be huge demand from the bigger employment hubs, the CBDs, the hospitals, the schooling, the education, the airports. And in the inner to middle ring suburbs, you can't just knock over and build another 1,000 houses and provide those types of things. So those fundamentals are there. And people want to live close to work and good schooling. And we all know about lifestyle precincts and walkability. And I don't know about you, Michael, but when I grew up, I think I had one coffee shop around the corner.
In Brisbane, actually, when I grew up, there weren't coffee shops. There were fish and chip shops, and that was about it, and
That's
the occasional Chinese restaurant.
Now, if you haven't got 5 coffee shops and 15 takeaway restaurants, nobody wants to live there anymore. So it's interesting as well, isn't it?
Yeah, well, I grew up on Nescafe. That was as good as it got. So what's ahead for our property markets? Clearly, we're moving through the phases of the property cycle. This is normal. And I know that our research is showing that there are headwinds, things that are going to hold up the market, and also tailwinds, things that are going to push us forward. So maybe we should just finish off our chat by looking at some of both the positives and negatives, because some people are going to say, oh, look, you're internal optimists. I know that we are realistic. We know there are challenges, but we're also optimistic about the long term. And that's, I think, the right way to be. So if we look at what's going to drive property values over the rest of, well, not, I was about to say the rest of this cycle, but moving forward over the next decade or so, the positives in my mind are our increasing population, but also the decline in household sizes. There's actually fewer people in the average household. So that means that even for the same number of people, we need more houses, but it's a combination of strong immigration growth, and the latest figures have suggested that there could be 600,000 more people in Australia over this year and next year, over a 2-year period, than during the COVID pandemic, which slowed things down. So putting these 600,000 extra people in and understanding that they're not going to pack them in as many per household, that's going to be a huge demand for accommodation.
Yeah, definitely. And obviously, we started to see a lot of immigrants also returning, Michael, during the COVID period. And we're starting to see that trend as well. They're opting for a bit more safety and a bit more lifestyle, and they want to bring their kids up and in a bit more certainty in an area like Australia. So they're obviously returning as well. And that surged to about 320,000, as I said, over that COVID period. And we're currently, obviously short of those kinds of dwellings, and it's expected to remain strong moving forward.
Well, as we move through the rest of this year, I can't see a change to our low vacancy rates. There's just no end in sight for that. And we know that the government is going to still give some support. There's changes to government first homeowner activities, but they're still interested in supporting young people getting into the market. And all this is happening at a time when there's actually very few properties for sale. That will pick up as we move through the stages of the cycle. But all those people who are going to bring their properties up for sale, Brett, in general are going to be homeowners who are going to upgrade or downgrade, and they're going to be new buyers in the market as well. So that's going to lead for the next stage of the cycle. And it's likely interest rates are at or near their peak, which means that's going to provide support for property prices, and that's showing currently with strong auction clearance rates and short days on market, and the fact that vendors don't have to discount much. So there are a few positives, but there's also a few uncertainties ahead, Brett.
Yeah, and I think that's what people are kind of concerned about. We've already seen the impact of the rate hikes. There's obviously been a number of rate hikes, and that's probably not going to flow through for another couple of months. It usually takes time to come through. So, I know they're talking about holding fire and seeing how things work out. So I'm hoping that that's probably the case at the moment. It's a good opportunity just to see how things play out. Obviously, we've talked about 100 different cliffs in the last 12 months, Michael, and the next one's the fixed rate loan cliff. So there's about 880,000 fixed rates, due to expire in 2023, and potentially going to maybe 2 to 5% or even 6% as well. So.
Now, that's another cliff you said, but most of the cliffs, actually, no one fell off them. They were steps. Everyone's known about this fixed rate cliff. The risks that tend to get you are the risks that you didn't know. The real risk is all those things that come at you when you think you knew all the risks. I know a lot of home borrowers and investors have actually been refinancing and speaking to their brokers. So yes, it will hurt some, but at the moment there's very few defaults. But we're talking about what's possibly what the negative factors for markets are, and I think that's a very realistic one. So you said the interest rate hikes that haven't fully flown through, the fixed interest rate mortgages. What else?
Yeah, obviously there's household debts that's rising as well. There's cost of living pressures that are a lot higher than they kind of were, which is a concern. And I guess as we kind of go on, the wider economy, there's weaker global growth and rate hikes, and there's some issues going on in America with banks and things like that as well, and which may or may not flow through to Australia. And then finally, we're seeing the reduction of the capacity to borrow and tightening and more of a favourable 20% deposit on average earnings and things like that as well that are all coming into play and will play a role as well.
Sure. So in the short term, there are clearly some headwinds that are going to slow things down. So even though the market is moving into the next phase of the cycle, as we've said a few times, it's not a boom, it's the stabilization phase. But this is when fortunes have been made in the past, when people have picked the eyes out of the market without as much competition as during the boom phase, when they're able to buy good properties, quality assets that are going to see them through in the long term. And if you're interested in seeing what's possible for you and starting by putting a plan together so that you can invest in you and your family's financial future, why not have a chat with Brett and his team at Metropole? I'll leave a link in the show notes. Go to metropole.com.au. And we don't sell properties. So we start off by putting a plan together for you. And then if you want us to, if you allow us to, we will help you by using our buyer's agency services, our property management, renovations, development, and Ken Race with wealth advisory as well. So there's a number of ways we can help you. Go to metropole.com.au. And Brett, I know you're actually spending more and more time managing the team, but are you still keen to see clients?
Yeah, definitely. I really enjoy that. And particularly at the moment, I think there's a lot of uncertainty in the market, a lot of uncertainty in people's minds. But I think as the year goes on, that'll transition to more certainty and people will be comfortable to move forward. So I think there's certainly opportunities there, if the timing's right.
Sure. Well, again, there's not a particular way of doing things where we don't have a formula, that a cookie cutter approach that, hey, this is for everybody. So we really need to understand what your needs are. And as you said a moment ago, if things are right for you. So Brett, thank you, because I think it's important to understand the cyclical nature of the property markets. To become a good investor, you've got to make informed decisions about when to invest, how to invest. And I don't think until people have lived through a couple of cycles, they're actually a good investor. You have, I have, our team has, our research department has, and by recognizing the different phases of the cycle and the factors that influence them, I think investors can capitalize on the opportunities and minimize their risks, as opposed to doing what most people do and buying near the top of the market because that seems when it's the safest, and getting out near the bottom when in fact it's probably the right time to get into the market. So I guess the bottom line is keep your emotions in check, adopt a strategic approach, understand the cycles, understand the phase, and all this is likely to help you more likely have long-term success in property. Thanks for your time, Brett.
Thanks, Michael. Great to unpack it all.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to have a chat about the big difference between the rich and the average Australian. So do you want to know the big secret why the rich are richer? Well, many people have studied this topic. Many have written about it. Napoleon Hill wrote that classic Think and Grow Rich almost a century ago. Tom Corley studied the rich and the poor for 5 years and wrote his first book, Rich Habits. Then together we wrote Rich Habits, Poor Habits. By the way, there's a new edition of it out. It's just come out and you can get it. Go to Property Update and have a look at the website there in the bookstore and get the latest copy of Rich Habits, Poor Habits. Now, we found that many things separate the rich and the poor. Contrary to what the poor want to believe, it's not only luck, it's not fate. Tom Corley found that the poor prefer to believe the rich have got some advantage that they haven't got. This is the type of thinking that enables the poor to remain in their situation without taking any responsibility. Now, I'm not judging rich or poor people as good or bad. What I'm saying is if you want to become richer, if you want to become amongst the wealthy people, whether you choose property or your business or whatever, you've got to understand this big difference I'm about to share with you, why the rich keep getting richer. Sure, luck does play a part in your life, but lucky people do many proactive things to put themselves in the position to take advantage of luck when it strikes. But here's the big difference. The poor, and in fact the average Australian, focuses on survival. They focus on instant gratification. They don't tend to think beyond the moment. However, the very rich think and plan very far into the future. 5 years, 10 years, or even 20 years. The poor think about the moment. They think about the next pay packet, the pay period that they're getting. They think about the end of the week. The middle class, they're hoping to make it through the month. But the rich, they're planning a year out or several years out. They're planning into their future. Of course, multi-millionaires, decamillionaires plan out decades or two in the future. So if you want more money, if you want more freedom in life, you're going to have to learn about delayed gratification. Successful people have got the ability to work hard to accomplish a goal which won't be achieved for a long time. You've heard me say it before. Do the easy things now and you'll have a hard life later. Do the hard things now and you'll have an easier life later. Successful people possess this sort of higher patience and an aptitude to postpone the enjoyment of their work. That's because they understand that long-term success takes a lot of skills that unsuccessful people, they lack or they haven't experienced. Now, these attributes comprise proper planning for upcoming challenges, associating with the right people, self-confidence, tolerance. On the other hand, unsuccessful people, by and large, they can't see the forest for the trees. Learning to delay gratification rather than seeking immediate satisfaction, in my mind, is essential for success. And that's just as important when it comes to property investing. It takes time to allow the power of leverage and compounding to grow a large enough asset base for you in residential properties. While it takes time to change ingrained habits and approaches to life, things that you've probably been taught since childhood, the good news is it is entirely doable. Start with small alterations to your thought patterns. Acknowledge some of the poor habits that you've got, things that tend to lead to immediate gratification. Remember, if it comes too quickly, chances are you're going to lose it just as readily. All good things take time. You've heard me say it before. Please excuse me if I repeat it again. Warren Buffett wisely said, "Wealth is the transfer of money from the impatient to the patient." Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?